Great. First of all, thank you, Peter, for lifting the mood a little bit after the discussion around the fourth turning and global wars. Now it looks like the wars will be fought by robots, and so hopefully we'll continue this more optimistic vein around venture capital this time. So we'll go back to a little bit of venture, but a different part of the venture capital market. First, let me interpret this title here. It's a little bit of a mouthful of words. Investments in short-time horizon, private companies with an outlook towards liquidity events. So what we're really talking about here is kind of later stages of venture capital, but not the late stages of venture capital. So looking at companies kind of in the 200 million to $1 billion range. So there's still quite a bit of growth still left in them. But not SoftBank, Coatue, kind of late pre-IPO, 10%, 15% return just before the IPO. But looking more at the later growth stages, that's where we're focused. My name is Chris Fisher. You've probably met my partner Key at previous events if you've attended previously. And we're with the Global Public Offering Fund based here in New York City. Let me just give a little bit of my background, how I came about it, because you've probably heard it from Key, but I'll tell you, I have a different path, but ending in the same place. I'm originally from Ohio. Now I have some connections to Phoenix, but essentially grew up in Ohio. I did science undergrad, so physics. Went into technology, spent the early part of my career in industrial and consumer products. Very much during the NAFTA transition of products to kind of global places, which brought me to Hong Kong in 1998 to set up a sourcing and engineering operation to coordinate global supply chains. So I worked on a lot of systematic approaches to collaboration, tying engineering groups and production and different groups in a corporate environment together and
keep in touch.
Really applying technology into some of those challenges with globalization. So I was a passionate technologist, but that led me to Hong Kong, and I started to build my career very much in a global context. We sold that company to a company called Tektronic Industries in Hong Kong, which was consolidating global brands. So I'd spent 10 years doing M&A and using technology as the basis for integrating acquisitions around the world based in Hong Kong. Recently moved to New York last December, so I've been in Hong Kong for about 22 years. So reintegrating back, getting used to life back in the US, enjoying it very much, by the way. I can speak firsthand about how houses get smaller. The median home space in Hong Kong is about 470 square feet. There's obviously much bigger ones and much smaller, but when you're in a highly dense, it's 9 times more dense than New York City. There's about 45,000 people per square kilometer in the densest part of Hong Kong. So, if you go to Hong Kong, it looks a little bit like what an urbanized future might look like. And so now I'm back in the U.S. After the industrial, I went into venture capital. I had started angel investing in the kind of post-dot-com collapse debris around 2004, 2005. As I was traveling around the world doing M&A deals, I would come across founders, people with an interesting idea. Initially, it was primarily in the United States. So I invested in Key, actually one of his companies, Key Compton, my partner, in the ad tech, marketing tech in those early days. I'd met him in business school, loved his ideas, I loved his passion. And so I got involved in that company, which whet my appetite, and I just ended up building a portfolio of angel investments. After a few years of the M&A, I started to realize I enjoyed working with dynamic founders in technology areas where there was a growth mindset more so than these later stage declining brands, turnaround type work. So I went all in 2014 to just do venture capital full time, and joined a Series A focused VC fund. So started in the early stages. As I was doing that, I'm sitting in Hong Kong. It's a Hong Kong-based VC, but heavily investing in the U.S., about 60% U.S., about 30% Europe, and the rest in Asia at that time. And sitting there looking at what was happening, my investors in Asia, the limited partners there, were very much asking for shorter time duration. They were very concerned about the median time to IPO from early seed rounds to an IPO was about 12 years at that time, and it was trending more towards 14 or 15. And they were looking for, a quicker turn on capital. They wanted the risk. They wanted to be a part of building world-changing technology brands. They recognized that there was a shift in the public markets towards Facebook, Amazon, the FANG companies, and that a larger component of the S&P and the larger component of the stock exchanges worldwide was becoming technology. They wanted to be a part of that, but they didn't want their money locked up for 12 years, quite frankly. And at the same time, it was leading into, this is 2017, 2018, leading into valuation craziness and people throwing due diligence out the window, and a massive overhang of dry powder in the private equity and venture capital space, propelling the valuations up dramatically. So they were very negative on a venture fund at that time, but nonetheless, we raised a fund 3, deployed it into some really interesting companies. We were in Spotify, DocuSign. We did Meetup.com, which got sold to WeWork eventually. We got involved in quite a number of deals because we were nicely positioned in Hong Kong with limited partner money from Asia. But as I was going through this, I also became more concerned about companies staying private for just a very long time and the valuations getting out of whack. There's this situation where if you've kind of raised the C round, and then you go out for the D, your previous investors all want an up round. They're out kind of raising their next fund. After 6, 7, 8 years, they're out raising their next fund, and they want to mark to market and get TVPI and kind of boost their notional value of the fund, the NAV essentially. They want to boost that by taking later and later rounds. And one of the causes of that, I think, is pretty clear. Companies used to, back in the 1990s, they would raise an A, raise a B, raise a C, and then around the D round, they would go public. You've seen this with, basically Amazon, Microsoft, Intel, all those guys went public at what would be considered early today. That is not the case anymore. This time horizon to IPO is extending and extending. It's shortened somewhat with the SPAC phenomenon, which is a whole nother issue, and maybe we can talk about that at the end. But overall, the companies, the life cycle has been extending, and so fewer and fewer companies are actually, especially technology companies, are able to go public. So whereas we had a couple hundred companies go public back in the 90s per year, now we have 30, 45 is a good year for IPOs for venture-backed technology companies. So there's a number of reasons for this. They're typically rooted in regulatory. And in general, there's just more capital available, so companies can fund themselves through this time. But it's a bit of a Ponzi scheme when you get into the later rounds, because the later stage, just keep bidding the valuations up, and you do not test the true value of these companies in the public markets. I mean, where the rubber meets the road is what is the public market willing to pay for these companies. In the meantime, kind of dialing back to the venture capital discussion earlier, and also even to Peter's comments, there are some real changes in the world around the core technologies. These technologies build on themselves and on each other in nonlinear ways, such that now we have cloud computing, we have Um, we have a much more variable model for building companies. We've learned a lot. The capital's learned a lot. The venture capital ecosystem has gotten a lot more dynamic, a lot more collaborative, and is a lot more global, quite frankly. Significant now, rest of world venture capital fundraising eclipsed the US around 17, 18 or so. A lot of that's driven by China, but there's also in Southeast Asia, there's pools of capital, and there's more founders are starting companies outside of the United States. So there's this globalization. The ideas are very fungible. You get people from Y Combinator going all over the world. They go to India, they go to China, and they start their companies. So this dynamic has created a lot more competition, a lot more dynamism. And meanwhile, the capital has been, there's this overhang of capital and it's gotten larger. The returns have been fairly strong, especially since .com. And so it's as you can see, these are unicorn companies with a valuation of $1 billion or more. It's slightly dated. There's a couple thousand more than are on this slide, so some of these have scaled back, and some of them there's some new ones incumbent. But in general, this trend has persisted despite even this little bit of a correction.
Got a couple of minutes left.
Okay. So I only got 3 slides. So anyway, and I was hoping to foster a little bit of discussion, but so essentially, there's we're looking. The GPO fund was created really to kind of play between those late stage venture funds and the early stage, because there's a fundamental difference in how you essentially the risk level. So a Series A company, we were talking about product market fit earlier. That's a critical issue. By the time we get involved at a Series B, C, D, even we're doing a G right now. By the time we get involved, product market fit is well established, pricing is established, traction, all the key metrics. So we actually look a lot more like my M&A days. We have a lot of information to form a decision when we're inbound on a company, compared to the early stage where founders get hit by a truck, founders can't find the right market segment. The segment wasn't as big as they thought, all kinds of issues. The risk profile looks a lot more like a late stage, like a pre-IPO. But by the time you're at an E or an F or a G round, the upside has been relatively pushed out, especially by those kind of later stage rounds. So, where we're playing is we're kind of a C or a D. It's validated, it's globalizing. Typically, it's scaling. We can understand the unit economics. We have demonstration and proof points on the unit economics, and we have a good opportunity to really work with founders and founding team and CFO and start to assess them. And so the key observation that we have is that we've realized that the global capital markets are now sometimes in these smaller companies more supportive actually than US markets, especially if you look at markets where there's an accumulation of substantial institutionally managed assets. So if you look at a place like Australia, which has a superannuation fund, that every single, or a set of them, that every single Australian has to put 10.5% of every dollar they make into this institutional pool of capital. And that is then allocated across the set of asset classes. Some of it stays onshore, some of it goes offshore. But what they really lack onshore are global tech companies. They don't have a FANG, China has, they have their BAT, the Baidu, Alibaba, Tencent. We have FANG. Increasingly, Europe is starting to have some interesting companies. But a place like Australia, they don't have that. And so GPO, we're inbound on US companies that are globally scaling. They want to go into Asia. They want to build a SaaS company, for example, that has global distribution all around the world. And globally diversified revenue. These companies look really interesting. And so we view these other exchanges, these global exchanges, as viable growth sources of capital for these companies to get to those later stages without taking those later stage, highly dilutive private rounds. So by going public, they can collapse the complex cap tables that we have here in the U.S. The 1.5 lick pref on the F round. Take that to common, and then access essentially a global pool of investors. So that's the basic concept around what we're trying to do here. We think it's actually a kind of a separate asset class because the growth characteristics, we're generating returns in this category that they're not Series A, but the reliability, the volatility, dispersion of our returns, very consistent. But yet there's still a lot of upside. We're seeing 4, 5, 6x, kind of returns very solidly with relatively low risk and with the time to liquidity. If you have the option of liquidity within 2 to 3 years, we always recommend people hold them long term. The companies we're investing in, they're all going to become unicorns. So that's
fantastic. This is a really intriguing offering that these guys have. Key presented almost 2 years ago talking about a very nuanced way to get liquidity out of offerings and using what I would call like a Swiss Army knife approach of different markets outside the United States and the United States as well. I'm going to ask all of you guys to reach out to Chris and follow up more. I only have so much time for Chris